Are you on the hunt for some great quality dividend stocks amongst all this market volatility? Today I'm sharing with you 4 companies that have above average dividend yields and also consistent dividend payouts to their shareholders. So let's jump in and view these super safe dividend stocks that are great buys right now. First up is FedEx, ticker symbol FDX. They're the world's largest express package distributor. And during the pandemic, they did very well with the increase of online shopping and the need for home delivery. They've been struggling a little bit this last year or so as everything's been opening back up. Even though they still have a great free cash flow, last month they announced that they're increasing their dividend payout by 50%. So every quarter you receive $1.15, and that makes their dividend yield 2.06%. Along with this news and the news of changing up some of their board directives, the share price in mid-June jumped up 13%. Current share price of FedEx is $223.61. For the start of the year, they have fallen 13.5%. And just within this last month, they have grown 0.5%. Right down here, mid-June, that's where it jumped up 13% after the news of the dividend increase and the board of directives change up. So looking over here at the 52-week range, you see they're still close to their 52-week low, which was $192. And go down here, market cap of $58 billion, and they have a PE of 9.72. So if you're not familiar with PE is the current share price divided by earnings per share, which right up here is 23. Over on this growth tab, we can see Seeking Alpha gives the revenue growth a D+, having a growth ratio of 6.5. They're about 40% less than the rest of their sector. Going on here to their long-term growth, they have a ratio of 13.13%. So that's about 9.5% higher than the rest of their sectors. A good sign for our FedEx. Over on valuations, FedEx gives their PE value a B+, having a value of 9.72. It's about 35% less than the rest of their sector. And it's also about 30% less than their 5-year average. Right down here, looking at its PEG. PEG is your PE value divided by the long-term growth that we just looked at. So here their value is at 0.74, and that's about 43% less than the rest of their sector. For PG, you want to see the value of the company close to 1 being fair value. If it's underneath 1, the company is seen as undervalued, and over 1, it can be seen as potentially overvalued. Scrolling down here to price to free cash flow. FedEx has a price to free cash flow of $5.89, and that's about 60% less than the rest of their sector. Now with price to free cash flow, this is how much you're paying for every future dollar of cash flow, so you do want this to be a low multiple. In the teens, even better if it's in the single digits. Wall Street analysts consider FedEx to be a buy with a rate of 4.2 out of 5. And scroll down here, we can look at their price targets, and the current share price is about $23 less than their low price target. So that's a good sign that according to analysts, FedEx is looking like a good buy right now. Next up is Johnson & Johnson, ticker symbol J&J. They're a consumer healthcare and pharmaceutical company. They have products that range from Tylenol to Band-Aid, and these products are considered essential items to consumers, viewing the company as being able to withstand inflation and economic recession. They have a dividend yield of 2.52%, giving them a quarterly payout of $1.13. Current share price of Johnson & Johnson is $179.52. From the start of the year, they have grown about 4.5%. Within the last month, they have grown 1.19%. Looking here, Johnson & Johnson is staying pretty stable while the entire market's pretty much fallen in the last couple of months. So that's a good sign for the company during these volatile times. Over here, they are staying fairly close to their 52-week high of $186. Current market cap is $467 billion. And their current PE is 17.49. Johnson & Johnson is a large company, so as far as growth, Seeking Alpha gives them a D+, having a growth of 6.66%. They're about 57% less than the rest of their sector. And for long-term growth, pretty low right here at 3.54%, and it's about 70% less than the rest of their sector. For PE value, Seeking Alpha gives them a B- with a value of 17.49. They're about 10% less than the rest of their sector. And over here for PEG, because of that low long-term growth percentage, they have a higher PEG of 4.94 which is about 172% higher than the rest of their sector. Scrolling down here for the price to free cash flow, they're trading at $16.23, which is pretty much in line with the rest of their sector. Wall Street analysts are considering Johnson & Johnson as a buy with a rate of 3.73 out of 5. And scrolling down here, for the price targets, the current share price is right in the middle of analysts' average and low price targets. Looking at Johnson & Johnson has been pretty stable these last couple months, so they're looking pretty good, continuing with that trend going to the future. If you're finding value out of this content so far, let me know by smashing that like button. Next up is McDonald's, ticker symbol MCD. McDonald's is globally known as a great fast food restaurant. In these last couple of months, the restaurant sector has been one of the worst performing sectors out there. However, McDonald's, with their great free cash flow and large moat, has been performing fairly well. They have a dividend yield of 2.18%, and they'll give you a quarterly payout of $1.38. Current share price of McDonald's is $252.96. From the start of the year, they have fallen 5.82%. And within the last month, they have grown 0.78%. Over on this 52-week range, McDonald's is trading closer to their 52-week high, which was $271. Current market cap is $182 billion, and their current PE is 25.61. So they are trading currently at a more of a premium value than the other two companies we just looked at. Base to large, McDonald's is growing slowly, so Seeking Alpha are giving them a grade of D+, having a ratio of 8.23%. They're about 42% less than the rest of their sector. And over on long-term growth, they have a ratio of 7.26%, which is about 44% less than the rest of their sector. Also for the PE, Seeking Alpha is giving them a grade of D-, so with a value of 25.61, they're about 129% higher than the rest of their sector. Right down here for the PEG, they have a value of 3.54, which is about 267% higher than the rest of their sector. And scroll down here for price to free cash flow, they're trading at $21.81 compared to their sector average of $8.20. Even though McDonald's is trading more at a premium price, analysts are considering them as a buy with a rating of 4.3 out of 5. And scroll down here for the price target, the current share price of McDonald's is right in the middle of analysts' average and low ratings. Next is Broadcom, ticker symbol AVGO. They're a company that provides semiconductor and other software-related products. They have a very diverse industry, ranging from wireless to broadband, even automotive. Right now, they're looking at acquisition of VMware, which would further diversify their software business. Out of all the companies we've gone over so far, Broadcom has the largest dividend yield at 3.43%, giving them a quarterly payout of $4.10. Current share price of Broadcom is $477.84. From the start of the year, they have fallen just about 28%. And this last month, they have fallen 18.77%. Going over to its 52-week range, they are trading more at their 52-week low, which was $457. They have a current market cap of $192 billion and a PE of 12.95. Seeking Alpha are giving them a revenue growth grade of C, having a ratio of 13.34%. That's about 9% less than the rest of their sector. Going down here for their long-term growth, they have a ratio of 16.91%, which is about 13% higher than the rest of their sector. As far as their PE value, Seeking Alpha are giving them a B+, having a 12.95. That's about 23% less than the rest of their sector. And for a PEG, they have a value of 0.77, which is about 41% less than the rest of their sector. Being underneath that value of 1, they are looking at being more of an undervalued company right now. Scroll down here for the price to free cash flow. They are trading at $12.09 compared to their sector average of $16.01. According to Wall Street analysts, Broadcom is looking at a strong buy right now, having a rating of 4.53 out of 5. Scroll down here. According to analysts' price target, we're about $123 lower than their lowest price target, which is a good sign for Broadcom and looking like a sweet deal as being an undervalued company right now. I do have one additional company to share with you guys, but before I get to it, let me know your thoughts about these 4 companies and whether or not you're considering adding them to your portfolio. The bonus company is Lowe's, ticker symbol LOW, and Lowe's has over 2,000 retail locations throughout the United States and Canada, and their share price has been dropping dramatically the last couple months, really due to the concern of the increased inflation causing a decline in consumers doing home renovations. However, even through all this, they are performing very well and continuing to grow. They have great free cash flow, and their dividend yield is 2.37%, giving them a quarterly payout of $1.05. So with the decline, their current share price, as you can see here, is $177, and they are looking like a great buy, trading close to their 52-week low. If you'd like to dig deeper into Lowe's, check out my most recent video comparing them to Home Depot, and for other stock analysis, check these out. Catch you next video. Peace.